Welcome to the weekly video update, where I'll go over the action in the market for the week of July 24th through the 28th, and we'll see how things look for the week of July 31st through August 4th. We had another up week. We were up over 1% with the S&P 500. Our charts are still looking positive. On the daily side, we're showing some improvement after we saw that big down day on Thursday. We're still quite positive overall, and that is coming over into our weekly charts as well. We have a few charts that are a little overextended to the upside, but all in all, things are still looking okay, but we're also coming into a weak part of the year. Typically, the latter part of July into August, we see some weakness coming into the market, so don't be surprised if we see a pullback. If we see things start to really fall down, then we'll reevaluate things, see if we're turning more negative, and then adjust things accordingly. Before I get started, I usually don't do this on the daily videos, but I do on the weekly videos because not all of you watch the daily videos. I do put a PDF in the description for every video that I post. It's all of the slides and charts that you see. Some people find that useful to go through and follow along as I'm going through the charts. There's a condensed version of the daily video if you're really busy. It's about 8 to 10 to 12 minutes or so, with a stress on the or so part. Usually the full-length video I try to keep around 30 minutes or so. I just take out the charts and the bullet points and do what I call a condensed version of the daily video. So if you have a little extra time, you want to just view that, it shouldn't take up too much of your day. I do have a private Facebook group that you're welcome to join. So far, I'm the only one posting there right now, but if you want to come and join and interject some things, you're more than welcome to do that. Also, I will be posting a poll after I post this video, and I also keep a real close tab on YouTube comments. I want to keep the bot comments and the garbage comments away. I delete them as soon as I see them. I want the First Amendment to apply. If you want to express something, you're more than free to do that. Please note that at the end of this video, I also give you an email address where you can contact me that way. And just so you know, I also post videos on Rumble. Here is the channel right here. For whatever reason, if you can't find me on YouTube, go over and look on Rumble. If you're on Rumble and you can't find me there, come over and look on YouTube. All right, let's go back and talk about the week's session. For the week, we were up 1.01%. But volume was average. We spent most of the week being below average. The day that we saw above average was Thursday, and that kicked us up to being average overall for the week. The technicals are still positive, as I mentioned before, and I'll show you the charts. The market continues to be fixated on inflation and interest rates, and right now, that positive scenario that things are going to be okay is helping the market to go higher, but that could change at any time. We're also in earnings season right now, and so that can have a real impact on how things go. We won't be getting any scheduled Fed speak for the month of August. They must be taking it off, but they might do some kind of an interview or write an article or something like that. Our trend is still strengthening and it's positive. The ADX is above its moving average and the green line is going up. That's looking good. We're looking overextended in the short and intermediate term on the daily charts. So for the week, the Dow was up 0.7%, the Nasdaq up 2%, the S&P up 1%, and small caps had a good week being up 1.1%. Just some bullet points to go over of major things that happened. The stock market was up on earnings news, economic news, and central bank news. Ultimately, that all turned out to be positive. The positive scenario continues. This is what the market has latched onto, and they're still sticking with it. The idea that we'll have a soft landing, meaning that we're seeing economic slowdown, but we might be able to avoid a recession. We're really keeping an eye on the employment situation, and we're going to be getting that report this coming Friday. They're also under the impression that the Fed is close to being done raising interest rates, and even though we're seeing a slowdown, growth still looks positive going forward. The FOMC this past week did vote to raise rates another 25 basis points. We're now at 5.25 to 5.5%. And that was expected. There was a very high probability that that was what the Fed was going to do. That was not the surprising part. What was the surprise is what was Jerome Powell going to say in his press conference after they made the announcement. And when he did come out to his press conference, we saw some real whipsaw action. That was the real crazy day. When he first spoke, the market shot up. Then he said something the market didn't like. Then it went down. It was all over the place. And we kind of carried that a bit over into Thursday. The European Central Bank also raised their rates 25 basis points, or 0.25%, and now they're starting to speculate that maybe the European Central Bank could be getting close to being finished raising their rates. The Bank of Japan, they didn't change their interest rates. They met on Friday, but they voted to conduct its yield curve control policy with greater flexibility, saying that it will maintain a target rate of 0.5%. But it will offer to purchase 10-year Japanese bonds at 1% every business day through fixed-rate purchase operations. The reason I bring that up is in the weekly video and in the intermarket analysis video, when we look at interest rates, I always say Japan is its own little story. This is part of that story. Japan owns a humongous amount of U.S. Treasury bonds. If they have to sell those, when you sell, that's going to push prices down. That's going to make interest rates go up. That can have an impact on the bond market as well as flowing over into the stock market. Microsoft, Google, and Meta were companies that reported this past week. There was a whole slew of companies that did report. These are just the big names. And the S&P did meet resistance at 4,600. We gapped higher on Thursday. We hit that 4,600 level and then just went down pretty much for the rest of the day. Looking at the poll results for the last week's poll. The first question, this coming week, there will be another gauge of inflation with the PCE report. We got that on Friday. Do you think inflation will increase or decrease? We were split 50-50. The current scenario is that the U.S. economy will have a soft landing, that the Fed is close to being done raising rates, and that future earnings growth will be positive. 83% agreed with that. As of Friday's close a week ago, the S&P appears to be experiencing a short-term pullback. This can change quickly. Do you feel that the S&P will move higher after a pullback, 50%, develop into a downtrend and go lower, 25%, chop sideways without much conviction, 25%? We ended up having an up week. Also, as of Friday's close, there's a 98.2% probability that the Fed will raise interest rates 25 basis points after Wednesday's announcement. However, this number can change quickly. Do you feel that the Fed will raise rates? 83%. One person actually said they would lower rates, and nobody said they would keep rates the same. Let's go in and look at some Isabel Net blog charts. This tries to measure irrational exuberance, and it is showing some improvement. We're above zero, but we're not necessarily at an extreme reading, and it plots that with a log scale of the S&P 500. Then we look at the insider transaction ratio. It is coming down. As it's continuing to fall, we use that as a contrary indicator, and sometimes that can make things be more bullish. We also look at heavy truck sales. We're seeing an increase there. Stronger economy, stronger truck sales. Stronger truck sales, stronger economy. So they tend to work with each other. We're also seeing earnings projections really positive. Morgan Stanley is the dark blue, the consensus is the lighter blue, and they see us going up well into 2025. We look at growth projections on a global basis. We're looking at 3.5% for 2022, 3% for 2023, and 3% for 2024. The advanced economies are showing growth, but they're lower than the emerging market and developing economies, which they figure will see higher growth. We're looking at the first outflow in the past weeks from Japan. A lot of money's really been shooting into Japan, and I've been showing some charts in the daily videos that talk about that. We're starting to see some money coming out now. Folks are tending to save more now. Is that recessionary? If you think you're going to lose your job, or if things are getting kind of difficult, you start saving money, and we're seeing the savings rate starting to go back up. When we compare it to the year-over-year change in unemployment, and the personal savings rate is the light blue, it's also starting to move back up. U.S. stock price reaction to quarterly earnings per share beats or misses. If they move to the upside, it's kind of minuscule, but if they move to the downside, you can see over a 3% reaction to that. Sector fund flows. We're seeing money going into tech and coming out of energy, but we're seeing that turn up just a little bit. Looking at the FactSet earnings blog, where the first report says the S&P 500 is reporting a lower year-over-year net profit margin for the sixth straight quarter. This is what we're seeing over on the far right-hand side. It's still positive, but it's lower than it has been. Then on Friday, their blog post was just an update, and I have some text here. It says, at the midpoint of the second quarter earnings season for the S&P, the number of companies reporting positive earnings surprises is above recent averages. while the magnitude of these earnings surprises is below recent averages. As a result, the index is reporting higher earnings for the second quarter today relative to the end of last week, but still reporting lower earnings relative to the end of the quarter. The index is also reporting its largest year-over-year decline in earnings since the second quarter of 2020. Overall, 51% of the companies in the S&P have reported actual results for the second quarter of 2023. Of these companies, 80% have reported actual earnings per share above estimates, which is above the 5-year average of 77% and above the 10-year average of 73%. When you take it all together, companies are reporting earnings that are 5.9% above estimates, which is below the 5-year average of 8.4% and below the 10-year average of 6.4%. Now, let's get into our charts and do some analysis here. Here's the intraday chart. On Monday, we saw a little bit of a higher move, but then some selling going into the close. Tuesday, we did see a lot more buying coming in, and then some weakness entered later in the day. Wednesday was the day of the Fed announcement. We were lower, we settled down, and then right after the announcement was made, there wasn't much of a gyration. Then during the press conference, the market shot up and then the market shot down. Europe ended up having a really good day before the open on Thursday. We followed on the back of that. We gapped up pretty high. That was the high for the day. We came back down. It looked like we were trying to go back up. Then some news out of Japan started to ruffle the market a little bit, where we saw declines going all the way down to S2 and we bounced a little bit off of that. On Friday, we gapped higher again and were able to hang on to those gains and close closer to the high. For the week, all of the indexes were up. The NYSE was just barely positive, but the NASDAQ 100, the NASDAQ, and the S&P did about the best. Please remember that these are just the 5 trading days for the last week. It's not Friday to Friday. Going back year to date, the NASDAQ 100, the NASDAQ, and the S&P are the most positive. The mid caps are hanging in there pretty well, and all of the other indexes continue to be positive. Going back to the all-time high, all of the indexes are down. The NASDAQ 100 has been repairing a lot. It was in last place for a while. Now it's showing the least amount of loss. Looking at our sectors, this is for the entire week, where we had the communication, energy, and materials. They were up the strongest. What was down ended up being healthcare, real estate, and utilities. These are the more defensive sectors. Looking at our relative rotation graph, where we're seeing how discretionary is still leading. We're also seeing tech rolling over a bit, but it's still in the strong area of this chart. Communication, it's a little hard to see. It's this yellow line down here. It is showing some weakness. And we're seeing a little bit of improvement with the financials, where weeks ago I was talking about there was a lot of insider buying when we were really hitting lows in the financial sector. Now we're starting to see some improvement there. We're also seeing the industrials show some improvement, where the other sectors are still continuing to lag. Looking at all the different sectors for the week, we had communication, materials, tech, and discretionary up the most. The only sectors that were down were healthcare, financials, utilities, and real estate. Be a little careful about financials. Yes, there might be some insider buying that's happening, but we're not really seeing confirmation of that yet on the charts. Going back to the beginning of the year, we have communication, tech, and discretionary doing the best, where healthcare, energy, and utilities are doing the worst. Going back to the all-time high, energy is still hanging on to some gains, where all of the other sectors are showing some improvement as we've been coming back up, but we still have real estate, discretionary, and communication that are lagging behind. Looking at sentiment, we are extreme positive at 78. We actually ticked up higher than that. Looking at the historical chart, we came back down a little bit, but when we had the update on Friday, that ticked back up, just showing that there's not a lot of fear in the market, and we use this as a contrary indicator. Looking at the active asset managers, they are extreme positive now. They could still go higher than this. We tend to use this as a contrary indicator as well. Now there's 2 ways to look at some of these charts, and I point this out in the daily videos. We can say, yeah, they're overextended. We automatically switch to the other side, but at the same time, it can also suggest good momentum. Look at what was happening in 2020 and into 2021. We came up to these levels and stayed here for a while. We don't know if we're going to camp out here for a bit or if this is going to mark some kind of a top and then we're going to fall from here. Here's another chart also of the active asset managers showing how they came in at 101.82. Looking at the VIX, we still continue to decline with the line chart and the bar chart suggesting that there's really no fear in the market. The Ulcer Index is also very low, suggesting there's no fear. We're also looking at cash and we're comparing it to the tech sector. The black line is going down. When the tech sector is going up, this black line will go down. So it's kind of reverse logic. When we saw this real decline from 2009 all the way up until 2022, this is when the tech sector was doing very well. When it started to go back up, that's when we were running into trouble in the market, and now it's continuing to go back down. Also, keeping an eye on the RIDEX bear bull ratio, folks are getting a little more optimistic. This chart goes down when the market goes up, and it goes up when the market goes down. As we're seeing this fall, folks are favoring more of the bullish side. We also had the latest reading from the American Association of Individual Investors. They were more positive a week ago, and then we kind of started to bump a little bit, so they came down, but they're still positive. When we really pay attention to this is when we get to an extreme reading. While it's not extreme, we can tend to go with this. I also follow the red line, which is a moving average of how they've been changing in their emotions over time, and it's showing some improvement, but it's still below zero. Looking at the economy, we have a new quarter, so now we have new estimates for what the GDP is going to be. The range of the top 10 and bottom 10 forecasts, a little bit over 1% to the upside and about minus 1% to the downside. Looking at this graphically, we're starting to see some improvement with the third quarter GDP projections. So far, we still remain positive with GDP, and that's one of the definitions of going into a recession is we drop below zero. We're looking at the spread between risky bonds and not as risky bonds. This ratio continues to drop off. If we were really worried about the economy, we would see this ratio going up, and that's not what's happening. We're seeing a really strong correlation in the opposite direction between the S&P and this indicator. Looking at the latest reading in the Financial Conditions Index, we're still below the black line and declining. We get excited when we go above the black line. That's when things are turning worse. As we're going down, that means that things are actually getting better. Unfortunately, this has not been updated for quite some time. This still suggests that banks are tightening their lending standards. This has also not been updated for a while, the real-time SOM rule. We get excited when we go above the red line. That's the problem with these government charts, is the lag in the information. So a lot of times we don't know what's happening until well after it's happened. Seeing that same thing with the smooth U.S. recession probabilities. We're still down around the black line. We get concerned when we go above the red line. The Brave Butters Kelly Index, it does update a little bit more often, but still this is outdated a bit too. We are a little bit concerned with this. This is going up, so we want to keep watching this. Inflation, we're starting a new quarter again, so we're seeing pretty much a leveling off of inflation as measured by the CPI, the core CPI, the PCE, and the core PCE. Keeping an eye on the Fed. What do they think will happen on the September 20th, 2023 Fed meeting? As of the close on Friday, there's an 80% chance that they're going to keep rates at where they're at right now. 20% thinking that we're going to raise it another 25 basis points. This is going to change massively between now and then. Here's how we have changed. It's where we're at right now is the dark blue area. Then we look at it a day ago, a week ago, and then a month ago. But I'm just showing this for information because this will really change a lot. Looking at the Fed balance sheet, it's continuing to decline just as they said it would. And when we look at it on a year-over-year basis, it also continues to decline. Looking at our charts, the breadth, we're above the moving average based on price and advancing. That's positive. And we're showing some improvement based on volume. So this is suggesting that the market is healthy. Looking at the new highs, we are seeing them trail off a little bit. And we're seeing this on the daily charts too. But the 4-week moving average continues to go higher. We're turning down a little bit with our 10-week moving average. But this is still hanging in there. The advanced decline ratio is above the zero line and advancing. That's positive. Accumulation distribution, we're actually looking a little more negative on the daily chart. We drop below the moving average. We're on the weekly chart. We're still above the moving average and advancing. This indicator tries to measure what is the smart money doing, and we want to do the same thing that they're doing. Looking at our trend, we are showing a strong trend. We're above 20. We're above the moving average. The green line is on top and continues to advance. So that would suggest in a longer term time frame, we are in a positive trend. Looking at the Erin, where we're seeing the buyers are in control, we're seeing a decrease in sellers. Our oscillator has ticked up a little bit. It measures the difference between the green line and the red line. And when we're above zero, that means we're more positive and not necessarily extreme. The mass index is not generating a signal right now. Looking at some other charts, here's the daily chart. We came up to the underside of this trend line a couple of times and we've not been able to break through that. We also have some previous highs that may act as resistance. When you look at the bottom, where volume did drop off on Friday and Thursday, which is the one day back, that was the one day that we were above average. This is also kind of interesting, and I might want to bring this up in the daily videos. We're coming right up to this R level with our pivot points, and that may act as some longer term overhead resistance. When we look at the trend channel, we're still above the midline and advancing. That is positive. We're above the 50-period simple moving average, and both of them are going higher. That's positive. The long-term trend continues to be positive. The McClellan oscillator actually is ticking down, but it's still above zero. When we look at the summation index, we're starting to get a little extreme based on price. We're still showing improvement based on volume. Looking at the Swenlin trading oscillator, we declined based on price and volume, but we're still above zero. The Bollinger Bands, as represented by the percent B indicator, that measures if we're above or below one of the Bollinger Bands. We're near it, but we're not going above it on this chart. The bullish percent index, almost seeing this exact same thing on the daily chart. We're getting an extreme positive reading and starting to come back down. You can take this two ways. We're overbought and due for a pullback, or we could camp up here for a while showing good momentum. Also looking at the PMO, this is a momentum oscillator where we're going up and looking positive. We advanced based on price as well as volume. Then we do some studies connected to the PMO where we're declining with the percent of PMOs that are rising. We're also seeing a decrease in the buy signals, and we're seeing the same thing on the daily chart with the PMOs that are above zero. Is this extreme or just showing good momentum? We are seeing more broad participation, and that could help this indicator improve. Looking at all of our different oscillators, we continue to be pointing up, where we're starting to drop a little bit more negative on the daily charts in the short and intermediate term. The Chaikin money flow on the weekly chart is showing good solid momentum, showing a little bit of weakness on the daily chart. Again, this tries to measure what the smart money is doing. The Chaikin oscillator, it's actually turned negative on the daily chart, and we are declining on the weekly chart. The force index is still positive and above zero. The money flow starting to look extreme positive. It could stay up here for a while, or is this suggesting that we're overbought? The rate of change going back one period is positive because we were up on the week. Going back 50 periods, we are showing a bit of a decline. Looking at the RSI, we're just starting to become extreme positive. Going back 14 weeks, we just came off of extreme positive readings on the daily chart of the 14-day, and I also plot a 9-day RSI. The special K, we've been watching this closely. The daily chart is positive, the weekly chart is still negative, but it might be turning back up, but it takes a long time for this indicator to move. The Stochk RSI is extreme positive. The Williams percent R continues to be extreme positive. The ultimate oscillator, after being extreme positive, is now dropping back down. The Kopit curve, we're almost losing the Kopit curve on the daily chart, where we're still seeing this on the weekly chart. The vortex has the green line on top and is kind of extreme positive, but this is still positive overall. Looking at our weekly chart with our fib levels, we're well above the moving averages and the longer term fib levels, so they're really not relevant for right now. The different charts, we're looking positive with the Heikin Ashi weekly chart. The Kagi chart is positive, the Renko chart is positive, and the 3-line break is positive. We're seeing that same basic thing on the daily charts. We look at the ease of movement, and I plot two different things on this chart. We have equivolume on the chart. When it's green and up, that's positive. Red and down, that's negative. The thicker the bar, the more volume went into that move. Down below, what is the path of least resistance for the movement of the S&P? On a 1-week basis, we are showing a little bit of weakness, but when we go back 14 weeks, we're showing some strength. Looking at the point and figure chart, we had one new X drawn in. That's usually a positive sign. The last signal that we got from this chart was on May 15th, which is an ascending triple top breakout. Our different trading systems, we're positive with the Elder's Impulse system with green bars. We're also positive with the parabolic SAR system with the dots underneath. Looking at the broad market, the S&P, just a blanket chart here just to get an idea what's going on. We're seeing a little bit more of improvement with the S&P. The mid caps, they're still hanging in there, and they've been showing some internal strength, but they're not really breaking out based on price. The small caps have been lagging, but they're also starting to show some improvement. The Dow continues to be in an uptrend. The Nasdaq is in an uptrend. The Nasdaq 100 is in an uptrend. The mid caps are in an uptrend. The small caps were just starting to cross over. Now, I use two charts on the daily videos. I have the Russell 2000 index. That gave us a golden cross a week or so ago. The other small cap index that I look at is the S&P small cap index, and it just recently gave us a golden cross. If we see a golden cross on the weekly chart in the next week or two, that could provide more confirmation of the uptrend. The NYSE continues to be in an uptrend. The 30 biggest software companies doing quite well. The FANG index, it actually set a new all-time high and then fell back down below that. We're watching that level as well. ARC is showing some improvement. We're seeing a daily cross on the daily chart and also here on the weekly chart. All stocks continue to be in an uptrend. Looking at the Dow, and I go into much more in-depth analysis on the daily videos, the Dow is not breaking out to a new all-time high. I think it was like 13 of the last 14 days were positive for the Dow. Where we're seeing some strength is in the transports. It's really starting to break out. It has a ways to go to get to the all-time high, but if the transports do better, that could give a lot of good support to the S&P 500. The inverse of that is also true. If we see a breakdown here, that could put some pressure on the S&P 500. The utilities are lagging behind, and typically when the S&P outperforms the utilities, that's better for the S&P 500. Looking at the bank index, we're seeing the strength coming back into banks. We're above 50 with the RSI. We're turning back up with the MACD. Deposits are also showing a bit of improvement as people freaked out when we saw the banking crisis. We're still wondering if something else is going to happen. I understand that some bank went under in the Midwest just the last few days. Not really hearing a lot about that in the financial news. We'll have to see if that bleeds over into any other banks. The broad market, the CRB index is coming back up, but we're still in a downtrend. Copper is also chopping around a little bit. We've crossed over with the death cross on the daily chart, and we are showing some weakness here on the weekly chart, but we're still positive. Oil is starting to go back up. Now it's above 80. The dollar, after coming down below 100, has now been able to bounce back above 100. Gold continues to be in an uptrend. We saw some weakness, but now it's coming up to its 13-week moving average. Silver also continues to be in an overall uptrend. Looking at bonds and interest rates, the total bond ETF, we're chopping sideways, but we're still in an uptrend. However, stocks still continue to outperform bonds on a monthly chart. Looking at the yields, where we were chopping around, we really spiked up earlier in the week, especially on Thursday, and then we came back down a bit on Friday. Looking at a weekly chart internationally, the UK still has the highest interest rates, followed by the US, and then the German rates, and then they're coming back up to this 0.5 level or 0.5%. This red line is Japan, and that's what I alluded to earlier in the video. Keeping an eye on the MOVE index, we actually saw a tick down in the MOVE index with bonds, even though they were down. We saw a tick down with the VIX because stocks were up. We're still seeing quite a bit of a spread between these two, and we're showing that they're having a slight tendency to go in opposite directions. Looking at the 1-month yield and subtracting the 3-month yield, we're getting a negative result, which is what we should be, and that is more normal. This gyration that we saw was right when we had the debt ceiling issues. Our relative studies. First, we look at an intermarket analysis chart going back to the beginning of the year. Stocks are in first place, followed by gold, and we're seeing a decrease in bonds, and we're seeing a bit of an increase in the dollar index, and oil is actually turning positive on the year as those oil prices have been going back up. Going back to the all-time high or the beginning of 2022, we still have oil in the lead, followed by the dollar and then gold, where stocks and bonds are improving, especially stocks, but they are still negative back to the all-time high. When we compare the NASDAQ 100 to the S&P, they're both doing quite well, but the NASDAQ 100 is outperforming. The S&P 100 is starting to outperform the rest of the S&P 500. Growth is now outperforming value. And gold is really seeing a real underperformance compared to the S&P. We've actually now seen a death cross with this ratio. Bonds continue to underperform stocks. Gold is also kind of underperforming the dollar. We're having a hard time getting through this trend line right here, which is acting as overhead resistance. Low volatility stocks continue to underperform the rest of the S&P. Energy is also underperforming the tech sector. It outperformed in 2022. It's really seeing some weakness in 2023, even though it turned back up this past week. Discretionary is now outperforming staples. Looking at our secular and cyclical trend studies, first we look at the NYSE breadth thrust. This is the long-term seasonality and positive setup that I go through in every daily video. We actually triggered the signal back in October of 2022, and we've been coming up since then. This is indefinitely on the books. Then in March, we had another signal by the ZWAG NYSE breadth thrust. It was triggered when it gave us a really low reading and then immediately went to a high reading. This is also indefinitely on the books and is part of the positive backdrop. Looking at the Zohorchak method, this is also part of the backdrop. We were negative in 2022 and the beginning of 2023. Now we've generated a buy signal. These are other newer charts. This is a weekly chart of the S&P going back to the 2018 high and the 2020 high. I extended that line up here and we're so far above this resistance level. Can we hold above that level? If we start to see some problems and drop down below this, that could signal more of a decline. We also are seeing pretty much that same thing with the NASDAQ 100 weekly chart. We're above this resistance level. We don't know if we come back down if it will act as support. Usually it takes longer than that, but this is also looking positive for right now. When we compare the NASDAQ 100 to the Dow and do a ratio of that, we're getting a very high reading over here. The last time this happened, it was right at the dot-com boom. After that, we saw the dot-com bust. It took us 20 years to get back to this level. Then right before we started having trouble in 2022, this ratio got really high again and then declined. What's going to happen this time? We just have to watch this play out. Comparing the weekly chart of the S&P to the German DAX, where the German DAX is back to setting all-time highs. We're not setting all-time highs with the S&P. We're seeing the correlation kind of trailing off just a little bit between the two. Our historical momentum studies. I'm only going to show the one chart because we're getting so far away from this. I was going through all those other charts from previous years, but unless we start to really fall, I'm just going to kind of keep those charts on hold. Really what we're showing is the breakout above the trend line, and the MACD was positive at that time and continues to show strength. So what's our outlook? And this is based on just for Monday. We will have influential earnings reports that will be coming out. There's no scheduled Fed speeches for the month of August. The technicals are positive on the daily charts, but we're starting to become overbought. The economic reports on Monday will be the Chicago PMI. The geopolitical events. We're keeping an eye on everything on this list, but it's all about inflation and interest rates as far as the markets are concerned. Here is the economic calendar for the upcoming week. We're going to get 3 really influential reports. ISM manufacturing on Tuesday. We're going to get the non-manufacturing index on Thursday. And then the big one is going to be the employment situation report on Friday. Looking at the Stock Traders Almanac statistics. I usually don't do this all that much, but since we're beginning a new month, I wanted to go through the yearly backdrop. This is part of the seasonality and setups that I go through. Way back in January, we have a January barometer, and the barometer says that the year follows what happened in January 83.33% of the time, going back to 1950. We have a 3-0 score with our trifecta. Score number 1 was the Santa Claus rally back around Christmas, just after Christmas. Then we look at the first 5 trading days of January. That was positive. That gave us a score of 2. And then when January ended up being positive, that gave us a score of 3. When all 3 indicators were positive, looking at the next 11 months, because some people start this in February after it's already triggered, the markets have been up 87.1% of the time with an average gain of 12.3%. If you go back for the full year, we're up 90.3% of the time with an average gain of 17.5% in all years. The market also likes that we have a mixed Congress right now, split between Republican and Democrat. Then looking at August, and I'm doing this a little out of order because we still have 1 day left of July. Over the last 72 years, we've been up 55.5% of the time and down 44.4% of the time. In August, options expiration, which is still a number of weeks out, we're up 54.7% of the time and down 45.2% of the time. The week after options expiration, we're up 66.7% of the time and down 33.3% of the time. But looking at just the statistics for Monday, we're negative across the board with the Dow, S&P, and NASDAQ. We're coming into the last trading day of July, so I wanted to include it in this video where we tend to see some historical weakness. We're also keeping an eye on the NASDAQ. We're also seeing some historical weakness here. Then we shift into August. We haven't had the first trading day yet, but often we will see some weakness in the first part of August. Then we might see a little bit of recovery here. We might chop around for a bit of the month and then possibly see some strength going into the end of August. These are just historical averages. Anything can happen. We just use this as a guide. Going back to 1950, when we look at pre-election years, the S&P 500 is up and down 50%. They're split between the two. Our scenarios, and this just applies to Monday, but it hasn't changed all that much. We're not going with the down scenario right now because our charts are positive overall, but we could be becoming overbought. We're tending to lean more towards the positive side, but be aware, we could be becoming overbought or seeing some good solid momentum. What we're definitely not going with right now is the sideways trend, because on the daily chart, both the short-term ADX and the longer-term ADX suggest that we're in a strong trending environment. The green line, even though it's declining, is still on top, so we default to positive. The warning signs, we're wondering, is there going to be a convergence of these short-term bearish signals? Hasn't really worked out all that much. We see these signals kind of come and go, but they're not all coming together, at least yet. The longer-term trend signals may be signaling a top. Those are those weekly charts of the S&P and NASDAQ 100, where now we're above those resistance levels. If we really start to fall from that, that may mark a top. Seasonally and historically, we're coming into a weak time of the month. Also, that includes the first part of August. Our oscillators are turning negative on the daily charts, specifically the NASDAQ 100. The VIX is still showing a lot of complacency, that there's not much fear happening. The cumulative new highs and new lows for the NASDAQ continue to show weakness, even though a little bit of improvement has been creeping in lately. The 3-month yield is still above where we were at back in 2007, right before the great financial crisis. The S&P 500 growth is weakening, but it's still in an uptrend. Earnings season is more on a case-by-case basis. The positive signs, the long-term seasonality and setups that I just talked about, those are still in the background. The long-term daily special K chart is positive, where the weekly is negative. The longer-term equity put call ratio continues to be positive. The S&P is still above the downtrend channel upper line. I haven't been showing that chart because we're far away from that line. We're still in a risk-on posture. It got weaker earlier in the trading week and then saw some strength on Thursday and Friday's session. Lower price levels may provide support, but we haven't really tested this all that much yet because we haven't seen all that much of a decline. We'll be watching those different levels, and this can be a moving average, it can be a pivot level, it can be a previous high, it can be a Fibonacci level. We're watching all of those and all of the different indexes at the same time. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're above the overhead resistance, but they're still below daily pivot point resistance, where they came right up to that and then fell back. The Staples to S&P 500 ratio is continuing to decline. The Russell and the small cap index that we look at, as well as the mid caps, have generated recent golden crosses. Small and mid cap growth continues to be positive. The Copic curve on the daily chart, we're getting close to losing that signal, but it's still a buy signal for right now, where a few days ago the Pring bottom fisher generated a buy signal. So our conclusion, at least for Monday, the S&P remains positive, but it could be becoming more overbought. In the short term, we're seeing pretty much the same thing, as well as the intermediate term. Long term on the daily charts, we still remain positive. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a really good weekend, and I will talk to you in the next video.